Welcome to this explainer. Let's just dive right into the latest Rapaport Trade Diamond Index from August 13th, 2026. If you've been tracking the diamond industry lately, you know it's been an absolute roller coaster. Today, we're going to uncover the real story behind the global diamond trade. We'll be looking at the raw data to understand what's actually happening on the ground and, in the display cases all around the world. Here's how we're breaking it down today. First, we'll check the overall diamond market mood. Then look at the corporate winners and losers. After that, we'll zoom in on the fancy shape premium. And finally, do a quick spin around the globe for some regional updates.
All right, Section 1, the diamond market mood.
Before we even get into the hard data, we have to address the elephant in the room. Are diamond prices finally stabilizing? I mean, given the historic lows we've been seeing recently, it's the big question on literally every investor, miner, and jeweler's mind right now. Everyone is just holding their breath. Well, the 1-carat Rapaport Trade Diamond Index for the last 3 months tells a pretty clear story, doesn't it? After a really brutal, steady dip through May, June, and July, we are finally seeing it level off. A very clear, slight uptick for the 1-carat in August. And the report points out that this stabilization is mostly thanks to deliberate production cuts, which makes those highly sought-after goods much harder to find. Now, this data is absolutely fascinating. Look at the stark contrast between the short-term and the long-term numbers. Weekly and monthly, we're actually seeing some green shoots, like a solid 2% monthly bump for half-carat stones. Not bad, right? But then, you look at the year-over-year column. It is a bloodbath of deep, double-digit deficits for anything a carat and under. Half-carat stones are still down a massive 19% from last year. So yeah, the immediate bleeding might have stopped, but make no mistake, the market is still operating in a very deep trench compared to 2025. Moving right along to Section 2, corporate winners and losers. It's wild how much external forces are completely dictating corporate fortunes right now. Just look at this split. On one side, you've got Al Rasa taking a massive hit. Their first half sales dropped 36% down to $902 million, leaving them with a painful $130 million loss. That's a huge swing from their $475 million profit last year, and it's almost entirely due to tighter international sanctions and just generally weak global demand. But then, flip over to Brilliant Earth. Second quarter sales actually went up 6% to $115 million, netting them an $800,000 profit. How? By leveraging premiumization. They capitalized on higher metal prices to boost their average ticket value. It really is a tale of two completely different survival strategies. And across the broader mining sector, you can really feel the squeeze. Lucara saw their second quarter sales dip 6% down to $41 million. Petra is out here actively planning to sell off its Finch mine just to manage the portfolio. It's becoming super clear that for manufacturers, controlling production is literally the only reliable survival strategy right now. Pulling back on supply is basically the last lever they have left to balance out this tepid demand and try to support prices. But hey, it's definitely not all doom and gloom, and I've got 2 billion reasons to prove it. $2 billion. That is what Titan posted in their fiscal first quarter jewelry sales alone. That represents a staggering 30% jump year over year, driving their earnings up 68%. The catalyst? Incredible, solid demand during the Akshaya Tritiya festival in India. It just goes to show that localized cultural events can completely defy the broader global downward trends. For investors, this is a brilliant reminder that localized cultural drivers are incredibly powerful forces you've got to watch. Okay, zooming in from the corporate balance sheets to the stones themselves, let's hit Section 3, the fancy shape premium. Let's talk about what's actually selling, because consumer aesthetics are shifting super fast. If you're on the trade, you need to pay attention here. What's hot? Elongated shapes. We're talking ovals, marquises, emeralds, specifically those chunky ones, 2 carats and up. They are literally outperforming traditional rounds right now. Antique cuts are also flying out the door. But on the cold side, princess cuts are struggling. People say demand might be returning, but prices remain stubbornly low. And honestly, this is absolutely crucial. If you have fancy shapes with bad proportions, good luck. They are practically illiquid. Buyers are demanding absolute perfection in fancy cuts, and poorly cut stones are just not moving. To really put this shift into perspective, check out this metric. If you take a standard square cushion cut, right, and just stretch it out into a long cushion shape, boom, it suddenly commands a massive 20 to 25% premium on the market. A 25% bump just for the physical proportions of the rock. It's kind of wild to think a simple shape adjustment creates that much instant value. When it comes to retail demand, the US market is incredibly hungry for specific specs. They want elongated ovals in colors D through I and clarities from VS to SI. If you've got those on hand, the market is rock solid. But the real star of the show? The marquise. Because of a seriously short supply and sky-high demand, high-quality marquises have officially claimed the crown as the most expensive fancy shape available on the market right now. Wrapping things up with Section 4, Global Regional Updates. Let's do a quick lap around the world to see how regional seasonality plays into this. In Europe and the Middle East, we are deep into a severe case of what I like to call the summer slumber. The billiard industry is basically at the beach, officially in vacation mode until August 17th, so treating is practically a ghost town. Over in Israel, things are pretty slow for the summer break too. But Israeli businesses aren't totally asleep at the wheel. They're actually looking strategically at moving operations over to Belgium. Why? Because doing so lets them completely bypass U.S. import tariffs and snag that coveted 0% rate for the American market. Over in Asia, it's a really fascinating split. India is absolutely buzzing right now. They just wrapped up the upbeat International India Jewelry Show. Domestic sentiment has noticeably improved, and oddly enough, they actually have a shortage of the tiny stuff, stones under 0.01 carats. But then you look at Hong Kong, and it's super strictly divided. There's really strong bridal demand for those rounds and elongated fancies we talked about, right? In that half carat to 1.5 carat range. But anything under a half carat, super sluggish, mostly because mainland Chinese buyers have noticeably pulled back their spending. And finally, landing in the United States, the primary engine of global diamond consumption. The news here is surprisingly optimistic. The market is broadly strengthening across all categories, from 1 to basically 3 carat naturals down to the smaller sizes. Things are moving. The overall mood is highly positive as retailers gear up for the massive holiday season preparation that kicks off this September. So that brings us to the ultimate question, doesn't it? We've seen prices start to stabilize. We've watched manufacturers ruthlessly restrict supply to protect those prices. And we know American jewelers are right now, as we speak, prepping their displays for the biggest buying season of the entire year. So will this September be the catalyst that finally drags the global diamond industry out of its painful year-over-year slump? Or will these structural shifts just become the new normal? It is definitely a space we'll be watching like a hawk. Keep your eyes on the data, and we'll catch you in the next explainer.